do you think that the IRS and maybe other tax collection agencies around the world, do you think they are as technologically advanced or as educated as they need to be to actually police this stuff and catch people who are just flat out not paying? Or are they just trying to catch major offenders with some of the things that they've been doing? Hello, my friends. Welcome back to the channel or the podcast show, depending on where you're watching or listening. We've got a show all about crypto taxes, everyone's favorite topic to hate. We're going to talk a lot about crypto taxes. We'll talk about tools to help you achieve your crypto taxes this year. And we'll also talk about what the future might hold for crypto taxes and regulation, the IRS, and all sorts of interesting stuff like that. And joining me today is David Kemmerer, the founder and CEO of CoinLedger, who just happens to be the sponsor of the show today. So David, thanks so much for being here, my friend.
Yeah, thanks for having me. It's fun to be on and excited to talk about the boring topic of taxes,
Yeah. Yeah, it's always a heated topic for a lot of people. You've got opinions ranging from one side of the spectrum to the other. People saying crypto taxes should not exist, I'm not paying them, to people who say you should absolutely pay them and this is how you should do it. But across the board, everyone just kind of realizes this is something we kind of have to do. That being said, David, right before we get started on the tax topic, we're right now at the time of recording kind of in the midst of this crypto rally, whilst the rest of the world and macroeconomic conditions are pretty terrible. What are your thoughts on that? Do you think this is going to last, or what are your thoughts on the crypto market?
Yeah, I personally don't see it lasting. I would love to be proved wrong. But this to me it looks like, just momentum on the new year. Again, a lot of the tax loss harvesting is done and now people are kind of re-entering positions. Given the macroeconomic outlook and really technology sectors is abroad, I don't see how it lasts. But again, I would love to be proved wrong.
Hey, listen, I'll take it. If we're going to get some sustained movement upwards in price, I think that would be a nice thing. But it is that time of year again. We're at the beginning of the year here, towards the end of January. And so everyone's starting to turn their attention to crypto taxes. Unlike 2021, probably people are going to have a mix of losses and gains, maybe more on the loss side. So there's going to be discussions around how do we claim losses, how do we manage our taxes. Can you talk a little bit about how crypto is treated from a tax perspective today? Because it seems to change a little bit over the years.
Mm-hmm. Yeah, exactly. So at a high level, the IRS and most governments around the world treat cryptocurrency as a form of property for tax purposes. And really just what that means, you can compare it to other forms of property like stocks, like real estate. And really what that means is when you dispose of property, which is like a capital asset, you're realizing either a capital gain or a capital loss on that asset, right? Either you've made money on it or you've lost money. And no matter which way up or down it goes, that needs to get reported with your taxes, right? So if you're generating a bunch of income from, selling property, whether it's real estate or Bitcoin, that income is a form of capital gains and it needs to be, reported on your taxes. And then the amount of tax you're going to pay on your gains or your lack thereof, your losses, depends on your personal income tax bracket. So let's say, this year I made $80,000 as a software engineer somewhere. That will determine what bracket I'm in the United States. And let's say I maybe made $10,000 in capital gains selling and trading Ethereum and Bitcoin. Then my total income's $90,000, and that's the tax bracket that I'm in. So that's the percentage I'll actually pay on those capital gains. That's really the high level. So it's very, very comparable to stocks. If people trade on like Robinhood or E-Trade. But, of course, as you know, it gets a little bit more complex just because of the fundamental technical nature of cryptocurrencies.
Yeah, and it's fragmented, right? So you have, and this was the thing that sort of I got into myself, and this was several years ago, but as things changed from, it was really like Bitcoin, Ethereum, Litecoin, but, Litecoin's kind of out there. There were only a few coins, right? Like only a few chains that you could be participating in. DeFi really wasn't a thing. It was not as complex back then to do your taxes, but now if you're, doing DeFi stuff in, Phantom and Avalanche and Solana and Ethereum, you have all these different blockchains and different transactions and things to track. And often you have cross-chain transactions now that are even more complex. And so it's almost impossible to calculate these things and to make sure you're doing the right things and calculating things properly without some sort of tool. And so I guess this is as good an opportunity as any to kind of talk about CoinLedger, your product and what that does to help people kind of navigate this craziness.
Mm-hmm. Yeah, and you hit on the core problem on the head. Like, cryptocurrency is one of their biggest value proposition, right, is that they're interoperable, right? They don't require a third party to facilitate transactions, but it's that exact feature that creates this problem on the accounting and tax reporting side, right? Because I can freely move my Bitcoin off of somewhere like Coinbase into my own cold wallets, or like you said, onto different blockchains, right? All of a sudden it becomes very hard to track the original, what's known as your cost basis. How much did I pay for that original Bitcoin? Let's say I paid $1,000 for one Bitcoin, but then I moved it to a cold wallet, then I moved it somewhere else, and then I sell it, let's say 2 years later. It becomes very difficult to remember and to actually account for that original cost basis. So really what CoinLedger does at its core is it helps track all of those movements across wallets so that when you're disposing of property, disposing of crypto, we can quickly calculate how much did you actually make on that trade, right? If you sold Bitcoin again 2 years later, in our example, for $10,000, we can immediately calculate that you made $9,000 on that trade. Where people can get into trouble, right, is if they are trying to do things by hand or for whatever reason they don't have great record keeping. If you can't kind of prove your original basis, you can kind of get stuck with facing a larger than actual gain facing. For example, let's say I spent $10,000 on Bitcoin and I lost that original buy transaction, and years later I sell it for $50,000. If I can't prove and have that record of that original $10,000 buy, I might have to take that whole $50,000 gain. So really what CoinLedger is, it's an integration platform. It's cryptocurrency tax software. We integrate with everything. So we'll integrate with Coinbase, MetaMask, any wallet you have. You can sign up completely for free, use the platform to account and track all of your cryptocurrency transactions and movements, see exactly where your gains, losses, and income are. And then if you want to download our tax reports, that's when you would pay anywhere from $50 to around $300 for the year to download those tax reports. We've been around for a long time, so coming up on 5 years. So that's a little bit about CoinLedger.
So you brought up an interesting point. I want to go back to the plans and how you pay for stuff and what you get for that. But you just mentioned you've been around for 5 years. In those 5 years, what are some of the things, you as the CEO, you've been kind of steering the ship. What have you learned and how has the product grown and changed since you first started? What's different than day one?
Yeah, you actually touched on it earlier. When we first started, it was just spot markets on centralized exchanges. There was no credit, there was no DeFi, there wasn't multiple blockchains that people were using. So it was actually an easier problem to solve back then. Right. It was literally, we just integrated with Binance and Coinbase, and then we pull in that data and calculate your gains and losses. Now, of course, the complexity of transactions and what you can do in crypto, from NFTs to DeFi to cross-chain swaps, good for CoinLedger, maybe not as good for the average person who's trying to sort through all this crap, but it's gotten more complex. So the need for software tooling like CoinLedger has increased, again, because the complexity of these transactions is way different than when we first started with just spot trades. That's both opportunity for us and challenging for us, because we have to constantly invest millions and millions of dollars into this product to keep pace with how fast this market's moving, which is impossible to do, by the way, right? We do the best we can, but this market's moving so fast, and we have to constantly integrate with more and more and more platforms. But that's the biggest way that we've seen it change, is just, which again is a cool thing. It's the pace of innovation in this space, which we have to keep up with.
And to that end, right, you look at, even newer blockchains, and people have their opinions about Solana, but it's a great example. It was one of the first really popular blockchains for DeFi and NFTs that wasn't, strictly speaking, EVM compatible, didn't have the same data structure as Ethereum. it was a little more difficult to deal with from a wallet perspective, from a tax accounting software perspective. As more and more of those come out, like what does the workload look like for you and your team to support a new blockchain that's not kind of baselined on the Ethereum ecosystem?
Yeah, fantastic question. And these are all the pain points of building this product is you're so much on the cutting edge. And so the question is, what does it look like for us? EVM is easier now because there's so much developer tooling around that ecosystem. Something that is such a pain point is like, spinning up nodes to get in, the full transaction history of someone just by wallet address. Like that key piece of infrastructure, it takes companies to build that, right? We can't build everything. So everything, the cool part again is everything feeds off each other in this ecosystem as it does in any space, right? As more mature products come, clean APIs that we can use to get raw transaction data that's as low level as possible so that we don't have to be managing insane amount of node architecture. But typically we find, companies, infrastructure providers that we're comfortable with partnering with to get very low level on-chain data. Then we staff a full blockchain engineering team who takes that raw on-chain data and transforms it into, you can call it the actual transactions, because that raw data is just debits and credits to and from a wallet address, but those debits and credits could be interacting with various smart contracts. And those raw debits and credits are very different financial transactions, right? One is, let's say, a self-wallet transfer from another wallet you own. One is actually a swap interacting with a protocol like Uniswap. So our blockchain engineering team comes then and builds a classification layer on top of that raw data to actually make sense of, oh, this was a swap, this was interest income, because it's all treated differently from a tax reporting perspective. So you can quickly see how complex it gets, but we do have a very good process now. 2 years ago, we were figuring the best way to do this now. But I would go on a ledge and argue that our raw blockchain stack is the best in our market. So you go compare how we are accounting for everything from gas fees, transaction fees, just from your wallet address, I'd argue is the best out there.
Looking at that from the perspective of a user and thinking about, okay, I go in, I connect my exchanges probably through an API. That way I can get my exchange information out, so Coinbase or Binance or whatever. I might provide my addresses for my MetaMask and for any of my cold storage. And then you go in, you mash all those numbers, you pull all the data, calculate everything out. Someone gets to see that on screen. I think the thing that's missing for a lot of people is that every time you import something new, it's new context for that whole, I wouldn't even call it a model, but really it's kind of a model. Every time you import a new transaction, you basically have to rerun everything, because to your point earlier, if you're missing that $10,000 buy for Bitcoin, you've sold it for $50,000. If you bring in that $10,000 buy, you're like, oh, I found it. You kind of have to recalculate everything else because it changes the whole picture.
And it's a misnomer of these tools is that, oh, I just want to see my gains and losses for my MetaMask. It's like, it can't work like that because it's all tied together, right? If you solely import MetaMask, first of all, you're going to be missing all the original basis. Where did you originally get that crypto, right? Yeah. We cannot just magically assign the basis to it, right? We need to pull the Coinbase data or the Gemini data or the Binance data. I believe, 3, 4, 5, 10 years into the future, accounting and tax reporting for the space will literally just be connect to your wallet, and it'll be like amazing. It'll be like magic. But it takes so many iterations of the product and feedback from users to get to that point. And, we're still pretty early. But that's a little bit how we think through like product development.
Speaking of product development, what are some of the things that you're trying to accomplish in 2023? At least that you can share. You don't have to lift a lid on the whole private roadmap or anything. But I'm not sure. I did some brief research again before the video, and I didn't see it. But I wanted to know, maybe NFTs are in the plans, or you've already started doing that. Just a thought.
Yep. So on the NFT, we already fully support NFTs for all of EVM, Solana included as well. Again, I would love for people to go compare, contrast us against other tools they may use that we spent a lot of time on, again, to get right. So we're accounting automatically for all gas fees, transaction fees that you might have incurred, and adding that to your basis or subtracting it from proceeds, so it's reducing your total taxable income. A lot of tools in this space kind of sweep all transaction fees under the rug, so you're not getting the benefit. And again, with gas fees as high as they have been over the past 2 years, that's actually really important to minimize your tax liability. Other plans. So we've been pretty public about we're moving much more aggressively into the portfolio tracking space. Historically, CoinLedger, formerly known as CryptoTrader.tax, was solely kind of a tax product, right? And it was very important we started that way too, because it forces you to have insane integrity on how the quality of your data and how you're working with it. But now, over the next 12 months, you're really going to see us move into completely free portfolio tracking tools, and much more powerful than your traditional Blockfolios or Delta, because we were built from tax first, meaning we have all your basis data. We can show you exactly what your gain loss position is across your entire portfolio, which a lot of these tools like Coinbase can't do because they don't have that full scope of data and they don't have it from day one. So that's really, really exciting. We're spending a lot of time there. Outside of that, you're going to see traditional stuff. So more integrations, better tooling within CoinLedger itself to make it easy to reconcile your data, make it easier to figure out what's going on if we detect some missing data. That's a lot of it, and that's kind of at the high level, but it's going to be fun to build.
Incredible. So shifting gears a little bit here, I want to maybe talk a little bit more about some philosophical topics, get your thoughts on some things that are going on in the space and also what might happen in the future. I mean, I guess kind of bridging us from the tax conversation into some other things, do you personally think, you're pretty close to the tax space for crypto, do you think that the IRS and maybe other tax collection agencies around the world, do you think they are as technologically advanced or as educated as they need to be to actually police this stuff and catch people who are just flat out not paying, or catch people who are kind of cooking the books a little bit, or are they just trying to catch major offenders with some of the things that they've been doing?
Yeah. Now, I do want to just preface, I really don't have insider knowledge. I don't work at the IRS, but I can definitely provide my opinion. No, I don't believe that they're super technologically advanced. These folks, as you can imagine, are pretty lost when it comes to this stuff. Now, that said, one, they're catching up, and two, they're laying, you could call it roadblocks to, catch the most low-hanging fruit, right? Again, it started with adding, as everyone has probably seen now, the cryptocurrency question to 1040, which every taxpayer now needs to answer. Did you sell, trade, receive digital currency? That's kind of their first roadblock to be okay, how many people are doing this? How do we get our hooks into them? Then the other one, and these are kind of trip wires. Again, if you trip the wire, they would expect to see crypto income reported somewhere on your tax return. And then they can go in if they want and look closer at that. But it's not like they have this huge system that can see every single transaction, and tied back to a social security number. The other thing is on the 1099 information reporting side, which is coming, it was supposed to start this year. It's been slightly delayed by Treasury, but all the brokers in the space, so Coinbase, Gemini, Binance, they will in the near future be required to send a 1099 detailing your gains, losses, income. One of those goes to the IRS. One of those goes to you as the taxpayer. And so if you don't include the income that was reported on that 1099 with your tax return, that automatically, will flag a notice to the IRS. You'll get a letter. But that's kind of a long-winded answer to your question. I don't think they're super knowledgeable, literate on this stuff, but they are starting to lay kind of the tripwires to slowly catch up. And they move slow. Eventually, they'll probably be pretty sophisticated, and they'll bring in, contractors, private companies to help them do this stuff. They've reached out to us. We don't work with them at all. We're not a government contractor, but you can bet they're working with companies similar to us who've built similar technology to us to help them better understand, maybe the transaction history of some taxpayer that they're trying to audit.
I mean, let's just scope it down to cryptocurrency. If you think about what the future might hold,
yes.
Maybe what you think is going to happen and then what you hope might happen for its treatment from a regulatory perspective and from a tax perspective. What do you think?
Yes. So I'll give a couple answers. So on the shorter term, right, which is one, I actually don't think much is going to happen in things changing, which is a bummer because we need certain things to change. For example, stablecoin dispositions, right? Transaction with stablecoins should not be triggering, capital disposals, which need to be reported on an 8949, right? Most of these coins are stable, some aside, but it just creates a reporting nightmare, and you don't even have any gain or loss. So it would be great to get legislation being like, hey, USDC is not going to be treated as a capital asset, right? It's going to be treated as a monetary unit, and thus you don't need to use CoinLedger to track every time you use USDC to buy something, right? Do I think that will happen? I don't know. I mean, it depends how popular crypto gets, because again, politicians at the end of the day serve their constituents. If people get loud enough and bang their chest enough and get angry enough, that's what can incite change. But to do that, it needs to reach even deeper penetration, right, to really influence these politicians. That's one of my big things. Outside of that, I think just enforcement is going to increase. So the laws aren't going to change, but the way, again, they're setting the tripwires and they're trying to track this will just continue to increase. We talked about the 1099 stuff that's going to get rolled out. That's going to be massive. That's going to drive up enforcement so much because now, anyone who has bought, sold, traded crypto will receive a 1099 at around January. And those people, a lot of them aren't reporting anything now, and they'll be like, oh, I got to report this. I will say anyone who's listening or watching will do 20% discount for any paid CoinLedger plan with Hashoshi. Did I pronounce that correct?
Yeah, you got it, man. Hashoshi. I'll leave that information in the description as well, across platforms, so you have that. We'll put it up in a nice little banner up front so folks don't make it all the way through. You're still going to know about the discount code. But David, really appreciate you coming on. It was good to talk about taxes, your thoughts on the crypto market, maybe what the future holds for enforcement and all sorts of stuff like that. We'll have to do it again sometime soon.
We will. Appreciate you having me on. Take care.
Absolutely. Thanks everybody for watching or listening. Please check out this next episode. I'll link it up either on the screen or in the description of the podcast. And until next time, cheers.